Today, is a market pullback coming? Hi again, it's Martin North from Digital Finance Analytics, well, latest post covering finance and property news. And this is our weekly market update where we start in the US, go across to Europe, Asia, and end in Australia. And we also cover crypto, gold, and oil. It was a week of records and dips this week as shares opened higher in New York on Friday after the February jobs data failed to slow the market's upward momentum. The S&P 500 initially reset its record high, as did Nvidia, AMD, Meta Platforms, and Super Microcomputer in early trading. In fact, Nvidia rose 5% and Apple recovered above $170 a share. But the rally stalled as Wall Street took profits while US Treasury yields dipped after the Labor Department said US jobs growth accelerated in February, even as the unemployment rate jumped from 3.7 to 3.9%, and wages gains moderated. The mixed job report kept on the table an anticipated interest rate cut in June by the Fed, and the payroll data suggests that the Fed should be on hold, but the wage hours worked and household data all suggest that a cut will be appropriate at some point soon, Jefferies said in the note. But from here, it's possible that we will see a decent market pullback, perhaps 5 or 10% over the course of the next couple of months. Nvidia stock just as swiftly reversed direction to end the day 10.1% from its session peak, but it was still higher than its close last Tuesday. Having reset its record high to $974 US a share, Friday's intraday swing represented more than $200 billion shift in its market capitalization in a matter of hours for a company valued at $2.19 trillion US dollars as at Friday's closing bell. The reversal in Nvidia stock on Friday at least temporarily slows its move towards overtaking Apple as the second most valuable publicly listed company. Apple rallied 1% on Friday, lifting its market cap to $2.64 trillion. So far this calendar year, Apple has shed a little more than 10% of its value, but in contrast, Nvidia has surged more than 75%. Apple has been hurt by concerns about falling iPhone sales in China and the perception that it's lagging in the AI race. BCA research suggests that the S&P 500 is overvalued, and the optimism about profit margins is overly optimistic too. It pointed to Cisco as a warning for Nvidia investors. Cisco was the world's most valuable listed company back in 2000, trading at over 30 times sales, a similar multiple to Nvidia today. Yet, despite growing earnings per share nearly tenfold since then, Cisco's stock price is still 39% below its 2000 peak. So the question is, will Nvidia share Cisco's fate? Our guess, they say, is yes. All up, the S&P 500 and the Nasdaq reversed course, while the Dow Jones Industrial Average didn't even reach a record high. The Dow fell 0.18% to close at 38,722. The S&P 500 lost 0.65% to close at 5,123. And the Nasdaq Composite lost 1.16% to close at 16,085. The MSCI gauge of stocks across the globe rose to its highest level ever and closed then off 0.27%. Broadcom slumped 7% as investors noted that the semiconductor group did not raise its full-year guidance target despite posting better than expected fiscal first quarter results, suggesting wariness about the future, while Coinbase stock rose 5.8% to close at $256.62 a share. That's the highest since December 2021. Marvell Technology fell 11% after its first quarter guidance fell short of analyst estimate guidance, offsetting stronger than expected quarter four results. The weakness, however, marks an opportunity to buy, according to Deutsche Bank, who said that the accelerating AI tailwinds will likely boost the chip company's earnings power. Costco stocks fell 7% after the big box retailer reported second quarter revenue that missed expectations, as demand for higher priced items was dented by a more cost-conscious consumer. A lack of a membership fee hike from Costco, Oppenheimer said, was also likely weighing on the shares of the company. With the widely anticipated payroll numbers out of the way Attention immediately will turn to next Tuesday's US Consumer Price Index. TD Securities says we expect next week's CPI report to show the core inflation slowed to 0.3% month over month in February, after posting an acceleration to 0.4% in the last report. This week, central bankers from the US and Europe raised expectations that cuts in borrowing costs will begin in the summer on both sides of the Atlantic. The Federal Reserve Chair, Jerome Powell, testimony before Congress, went smoothly this week as he said that the Fed will certainly cut the interest rate this year, and he's not necessarily looking for inflation to hit the 2% target to start cutting rates. And he also said, by the way, that officials will review their plans to raise banks' capital under Basel III. But former Treasury Secretary Larry Summers told Bloomberg that he thinks there's a higher chance than a month ago that the Fed will hold rates steady through 2024. The Fed needs to be very careful in its judgment about what would be an epochal shift from the regime that we've had for the last several years, he said. The neutral cash rate is higher now than expected. In the note, Bank of America said monetary policy doesn't seem very restrictive according to most financial market conditions. Judging by the market pricing of the 3 cuts for 2024, the consensus indicates that with the observed progress in disinflation, the path of least resistance is for the Fed to start cutting rates around June. But it is worth asking the opposite question. With so much evidence the economy is running above potential, upside risk to inflation, and presidential elections approaching, isn't the path of least resistance to apply proper risk management and keep rates higher for longer? And elsewhere, news that Stephen Mnuchin, the former Treasury Secretary of Trump times, led a $1 billion cash injection into New York Community Bancorp. And that also smoothed investors' nerves earlier in the week as the bank rebounded more than 7.5%. Markets have priced in a Fed rate cut in June, with some traders even betting on a May rate cut by the Fed after the US employers added a surprisingly robust 275,000 jobs last month, even while figures for prior months were revised down to show fewer job gains. The dollar headed for its sharpest weekly drop of the year on the growing likelihood of lower borrowing costs and hopes of rate cuts, putting downward pressure on US government bond yields. The yield on the benchmark 10-year note fell to its lowest since the 2nd of February, but in late trade, it was only down to 4.076%. The 2-year note, which typically moves in step with rate expectations, fell to its lowest since February the 7th and was down to 4.478%. In passing, it's worth noting that the Bank of Canada left its rate unchanged at 5% this week as it continues to watch sticky inflation. Gold futures for April delivery rose by 0.97% to settle at a record $2,186.15 a troy ounce after hitting an all-time high of $2,202.35. That's a 4% gain for the week. Gold, of course, is a non-interest-bearing asset, so the prospect of lower interest rates lowers the opportunity cost of owning gold relative to interest-bearing assets like bonds, boosting demand. Yet, global gold exchange-traded funds collectively saw another outflow in February, extending their losses to 9 months, according to the World Gold Council. Total assets under management in gold ETFs fell by 1.8% in February to $206 billion. But this charge from Mishtalk links the fate of gold to the faith in central banks or not. And, well, does it suggest everything is under control? Oil prices settled lower on Friday, wrapping up the week with a loss as concerns about oversupply persists. The US crude futures was down 1.37% to $77.84 a barrel, and the Brent contract dropped 1.1% to $81.88 a barrel. Both benchmarks fell more than 1% across the week. Over in Europe, a day after the European Central Bank held rates steady, there was a lot of confusion and uncertainty regarding when Europeans could eventually start cutting their rates. The ECB President Christine Lagarde indicated that officials may be in a position to cut interest rates as soon as June. The German bond yield recorded their biggest weekly fall since mid-December. The central bank cut some of its growth and inflation projections too, now seeing inflation at 2.3% this year, below the 2.7% projected 3 months ago, while the growth outlook remains weak. That said, data released earlier on Friday showed that German industrial production rose in January by 1% from the previous month. That's above the 0.6% predicted, and a significant improvement from the revised drop of 2% at the end of last year. The Stock 600 index for 600 companies hit a new lifetime high, ending just 0.02% higher. The DAX index in Germany traded flat. The CAC 40 in France traded 0.15% higher, while the FTSE in London dropped 0.43%. The UK's budget day this week was a bit of a damp squib. There were some limited tax cuts and other soothing news on alcohol and fuel duty at the expense of some public services, but hidden in the numbers are further dramatic cuts in government spending after the election. And the Tories also nicked another policy from the opposition to make their job more difficult still. It's a mess, though the 10-year gilt yield remains steady at around 4%. Looking at names, Informa stock rose 2% after the UK information service provider increased revenues by 30% to £3.2 billion in 2023, with underlying profits coming in ahead of expectations. Informa updated its guidance for this year, with its strong free cash flow, meaning total dividends for the year were 84% higher year on year, and with a $550 million return to shareholders via buybacks. In Asia, MSCI's broadest index of Asia-Pacific shares outside Japan was up 1.01%, but Japanese shares were hit by growing speculation that the Bank of Japan was close to ending its negative interest rate regime, potentially as soon as March. Strong wage data for January released on Thursday further this notion. Any rate hikes by the Bank of Japan would mark the end of the monetary stimulus enjoyed by Japanese markets for nearly a decade. Ultra-loose policy was also a key driver of the Nikkei's record high rally in recent months. Japan's Nikkei 225 traded 0.2% higher on Friday, but that's lower than an earlier record high set in the week. The broader Topix index also fell slightly. Investors pushed up the yen after reports that Japan's central bank may indeed begin hauling up rates from negative territory as soon as this month. Against the Japanese yen, the dollar weakened 0.65% to 147.07. South Korea's Kospi rose 1.24% via another record high on some profit-taking in technology stocks, while India's Nifty 50 was at 22,484. China's Shanghai Shenzhen's CSI 300 and Shanghai Composite indices rose 0.43 and 0.61% respectively, as optimism over stronger than expected trade data was largely offset by the threat of new US restrictions on Chinese companies. The US Senate's Homeland Security Committee on Wednesday voted in favor of a bill that could potentially restrict business with China's biotech companies, the most prime example being Wuhai AppTec. Hong Kong's shares of Wuhai AppTec slid 16%, while those of affiliate Wuhai Biologics slumped nearly 20%, and the Hang Seng Index, though, ended up 0.76%. The passing of any more US trade restrictions on Chinese companies raises the prospect of more trade ructions between the world's largest economies, a trend that bodes poorly for the struggling Chinese economy. In fact, China has set an economic growth target for 2024 of around 5%, which many analysts say is ambitious and without much more stimulus. There is little visibility as to how this might be achieved, but the central bank governor told a news conference this week that there was still room for cutting banks' reserve ratio requirements following a 50 basis point cut in January, which was the biggest in 2 years. And he also said that maintaining price stability and promoting a moderate price recovery will be a key focus of monetary policy amid signs of persistent deflationary pressures. Last month, the central bank announced its biggest ever reduction in a key mortgage reference rate in a bid to prop up the struggling property market and overall economy. China has pledged that growth of total social financing and money supply will match expected goals on economic growth and inflation this year. Outstanding yuan loans was expected to grow by 10.2% in February from a year earlier, down from 10.4% in January. And broad M2 money supply growth in February was seen at 8.8% compared to 8.7% in January. Any acceleration in government bond issuance would help boost total social financing, or TSF. That's a broad measure of credit and liquidity. Outstanding TSF was 9.5% higher at the end of January than a year earlier. That's the same as the end of December. The Australian share market closed above 7,800 for the first time in its history on Friday, riding higher before the drops in the US. The ASX 200 added 1.07% to a record close of 7,847 points, driven by a rally in bank shares such as Commonwealth Bank, which jumped 1.84% to a fresh record high of 121.45. NAB, Westpac, and ANZ Bank all set fresh multi-year highs too. The ASX Big Four banks and Macquarie underpinned the market's 1.3% rally over the week as lenders claimed records and multi-year highs, adding $25.6 billion in value to the financial sector. But the banks are actually an interesting case study. Weak conditions in credit growth have fueled an outbreak of loan discounting that is heaping fresh competitive pressure on the major banks, posing a threat to profitability following a months-long ceasefire in the mortgage wars. While their margins are still threatened on both deposits and lending, investors are actually looking through near-term concerns about the economy and focusing on that rosier outlook where rate cuts help spur lending growth, and there's a prospect of bad debts improving and a bit of cost-cutting to be had too, but could be hopium. Some fund managers, such as Sean Sasquiria at Australian Eagle Investment Management, remain sceptical of the rally in bank shares and points to the lenders trading on historically high profit multiples. He said Commonwealth Bank now yielded just 3.8%, assuming dividends of $4.55 a share in the financial year 2024. The move higher was made as investors shrug off consistent slices of indifferent news, a data point that showed rate cuts could be delayed, so-so corporate earnings, or this week's decidedly tepid GDP print. The gains are now adding up to something serious, with the index up 15% since the global rally started in November 2023. At the heart of this is the seemingly unshaken belief that the soft landing can be achieved, inflation has been tamed, and rate cuts are just a matter of when, not if. Near-term weakness, as described in that GDP print on Wednesday, is apparently nothing to be concerned about. Growth of 1.5% for the December bolstered hopes of earlier rate cuts from the Reserve Bank against existing market expectations for August or September. The recovery is coming, they say, aided by rate cuts in the US and Australia and continued fiscal stimulus, including from Stage 3 tax cuts locally. So don't mention the GDP per capita recession or the China weakness. Actually, it seems larger companies with strong market positions are being chased as to be best placed to cut costs and hold the line on price where possible and generally control their competition within the banks. For example, you see that, or CSL or Goodman Group. They're leading the markets higher. Quality earnings, reasonably solid growth, and market power is the heady cocktail. And to that is takeover action. All of a sudden, there's more than 20 takeovers afoot, with many driven by overseas companies taking advantage of their own pumped-up share prices and relatively weak Australian dollar. But names were mixed, with fund manager GQG Partners shares losing 1.8% after Pacific Current said that it had sold its stake. Magmatic Resources shares surged 37.8% after Fortescue Metals took a 19.9% stake in the New South Wales Copper Gold Explorer, and Hub24 shares added 2% to a record high of $41.76 as Chief Executive Andrew Alcock said he was confident that the platform's business could continue to grow strongly over the long term when it released its full-year results in February. Shares in dual-listed lender Virgin Money surged 32.9% to $4.08 after it snarled a $5.7 billion takeover bid from Nationwide in the UK. And the yield on two-year Australian government bonds slipped over the week to 3.651% as bond traders marginally increased expectations of the pace of interest rate cuts. The Australian dollar added 1.4% during the week, in which China announced big new infrastructure programs, and it's currently buying just over 66 cents at the closing bell. And over in crypto, Bitcoin started the first half of this week with positive momentum, but faced a quick selling set of pressures as it tried to break through the previous record high of 69,000 US. The selling pushed the cryptocurrency down. While it did not cause a trend change, it did cause a loss of momentum in the cryptocurrency's mid-term upward trajectory. It was last at 68,102. Against this backdrop, Ethereum recovered better than Bitcoin in this week's pullback and returned to its uptrend and continue its movement towards the $4,000 US band. It was last at 3,908 US. So standing back, you can see here that the markets are still exceedingly extended on a relatively narrow base, but there are cracks appearing in some areas, and I think the pullback that we saw late in the US is an important signal ahead. It will be interesting to see whether the AI boom supports the market or whether, in fact, markets get a bit jittery. The prospect of rate cuts are still there, but as is sticky inflation. So the game is not yet set for a clear outcome. Therefore, as I said at the start, there is a significant chance of further pullbacks ahead. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.